Hello everyone and welcome to your Glassnode video report for week 21, 2022. So we are going to dive into both Bitcoin and Ethereum this week, and we're going to be looking at this from the lens of the dent that this current bear market has put into many of the long-term price performance metrics. You may have heard for a long time this concept of diminishing returns, which is essentially that Bitcoin and Ethereum return a lower amount as they get larger and valuations get bigger. They require more capital to move them. And what we're going to try and do today is really visualize this concept. We're then going to take it a step further and look at the derivatives and the on-chain space for both Bitcoin and Ethereum and really explore this from a fairly detailed but also broad perspective. So as we all know, this recent 12 months has been pretty brutal. We've seen two 50% drawdowns. Just over a year ago, we were selling off back there in that May sell-off in 2021. This is when we saw all of the energy and Elon Musk and all of these things kind of unwound, and we saw that first 50% sell-off. We obviously had an all-time high rally, and then we've pulled back again, and we've continued to kind of trade lower over the last couple of weeks. So it's been a fairly challenging 12 months. And what I really want to do is capture what the impact of this is on the short term, on a monthly basis, but also look at it on a very long term. We see Bitcoin trades in these 4-yearly cycles. Now, we're then going to bring in Ethereum to the mix and actually compare these two assets in terms of their long-term price performance. We're going to look at a Bitcoin to Ethereum market dominance metric, which purely looks at those top two, considering they tend to be the bellwether for two different sides of this market. We'll discuss that in a bit of detail. And then we're going to close out with two concepts. The first one is how uncertainty continues to be priced into option markets, particularly in the very, very short term, 2 to 3 months. The market has a lot of uncertainty and a lot of downside risk being priced in at this point in time. And where we're going to close out by looking at on-chain transaction fees, which for Bitcoin and Ethereum, really the demand for block space should manifest if, in an ideal scenario, high demand for block space and utility of these networks should manifest as a higher fee rate. And at this point in time, we actually have very lackluster fee rate. And for Ethereum in particular, that actually means that the amount of burning that's going on of ETH due to EIP 1559 actually hit an all-time low. Granted, it's only been active since August, so we have a relatively small short-term data set. Nevertheless, we are at an all-time low in terms of total ETH burn. So there are ramifications of what happens when on-chain fees are not quite at the level that we would all hope them to be. So as usual, before we get kick-started, please do give us a share and a subscribe and a like and a comment below if you do enjoy this type of content. We're going to explore some concepts you may not have heard before, a bit more about the price performance, and again, focusing on the Bitcoin and the Ethereum side of things. And I would recommend we do have a research paper that's going to be coming out on Wednesday this week, looking at Ethereum specifically, exploring how the network has been used through its entire history using the concept of gas and gas pricing. So do keep an eye out for that. Keep an eye out for our post on our Twitter profile and on our insights page. Let's get started. Okay, so here we are in our week 21 dashboard. We've called this week's newsletter a bear of diminishing returns. And you may have heard this concept. The idea is that as Bitcoin and Ethereum get larger in size, institutional capital comes in. And when they're of this size, hundreds of billions of dollars, it requires more capital to move them. There's also things like derivatives and options markets and various other tools that allow for that capturing of volatility. And we also see that there's information asymmetries. In the early days, Bitcoin was very, very unlikely to succeed. Lots of risks back in 2015, even more back in 2013. We see a lot of those risks start to evolve. The technology develops, the market awareness develops. And over time, we do tend to expect that with that risk getting squeezed out of the market, we also tend to see diminishing returns. So we're going to explore this concept and we're going to come at it from a number of different angles. Now, let's start with our usual price action. And after last week, last week was a fairly serious sell-off. We all talked about, the lunar collapse and all the ramifications that are going to come from that. At the moment, we've essentially been consolidating following that. This is fairly typical where we see markets kind of have a large sell-off event or a rally, and then it moves into a bit of a consolidation phase as the market tries to work out which way are we going next. And this is, again, within a very, very tenuous macro backdrop. There's rates hiking. There's all sorts of macro inflation and just general challenges in the current economy. So fairly shaky ground and just something we need to be paying attention to. But again, let's always bring it back to the data and try and explore what we have, what tools we have available to us, and understand what's going on as best we can. Now, I'm going to zoom in on our trend accumulation score. You may notice that I keep this metric here as a bit of a roadmap. It's a nice one to start with, and it's a good pair to go alongside our price action because it gives it that on-chain backing, what's actually going on under the surface. Now, what we can see, this is actually notable. Over the last couple of weeks, in fact, I would argue for this week entirely, we have seen very, very high scores. In fact, you can see here, sometimes it's hitting 1, 1, 1, 1. This was 4 days in a row where it was essentially maxed out. And we've seen most of the days since the sell-off from Luna be in the plus 90%, 90 range, 0.9. Now, this signifies that overall, over the last 30 days, a huge portion of the market, whether they're shrimps, whales, everything in between, have in general been adding to their balance. We have seen that people have found a new source of demand down here. Now, again, this is not necessarily always going to signal that a bottom is putting in. As we saw up here, we had high numbers and it continued to trend lower. But it is an insight that we've seen from a period of fairly soft accumulation. And what I impress upon you is that for a lot of this stuff with on-chain, think about it from a psychological perspective. We've seen a change in the way that people are behaving down here. Up here, we had intermittent accumulation, and then we had a serious patch of softness that resulted in a sell-off. Here we've seen that price has corrected down to a lower level and there's been a bit of a change in investor sentiment. Again, doesn't mean the bottom is in, but it means we can start looking for evidence and pieces of information that tell us what can go from there. But anyway, that's what I want to leave you with the price action and the accumulation score, just that basis of ground to get in market psychology. Have we seen a shift in the way people are thinking? And then we can look more into this. And next week, we'll explore this concept in a little bit more detail. But for now, what I really want to explore is about this pricing metric. This is price performance. These are typical metrics that you'll see in traditional finance, in equities. They'll use metrics like these to try and assess relative performance. How are these assets performing in terms of their price appreciation? Now, the top two are looking at the monthly return profile. So basically, how much has Bitcoin returned over the last 30 days? If you're just holding spot, how has your portfolio performed? Negative values obviously mean that you've lost money, which unfortunately in this instance we have, whereas a positive value is the converse. That means that the asset is appreciating. Now, on the left-hand side, we have BTC. On the right-hand side, we have Ethereum. You'll notice this a few times, and this is actually a bit of a takeaway. Notice how they actually look quite similar. They're obviously not exactly the same because the price charts are different, but you can see here that Bitcoin for the last couple of weeks has returned something on the order of minus 20%, minus 30%, minus 31% at the worst-case scenario. Now, because this is a 30-day metric, we're essentially saying if we're getting negative 30, it's saying that Bitcoin has essentially lost 1% per day for the last 30 days. Pretty grim. This is the reality of a bear market. We do see these weeks on end. I mean, this is actually the 8th weekly red candle for Bitcoin, which is actually a first time in history. So it is one of those things that we are starting to get a real feel for how severe this bear really is. And it shows you how intertwined with Bitcoin the macro environment is, because we've essentially got this poor performance within a whole set of poor performance across traditional equities as well, and even bond markets and things. It's tumultuous times at this point. Now we can see here where Ethereum, we're actually returning minus 36, minus 37. So Ethereum has in fact underperformed Bitcoin in this instance. And we're going to explore this concept a little bit more. For those who've been in cycles, in Bitcoin and cryptocurrency cycles for a number of times, this is fairly typical, where we see that during the worst parts of the bear, we tend to see a rotation back towards Bitcoin and Ethereum, but the larger caps tend to see more inflows. In this instance, we're seeing that Bitcoin is outperforming, but let's also consider the fact that considering these values are negative, the US dollar is outperforming both of them. So Bitcoin is outperforming Ethereum. Ethereum is underperforming Bitcoin, but they're both underperforming the dollar. This is generally the nature of a bear market. Now, that was the short term. Note how we tend to see these negative prints during large capitulation events. We don't usually get weeks where we get this 30% drawdown in a single week. It's fairly uncommon. They're not the rarest things, but they do happen. They're typically associated with the major sell-offs in bears, typically at the start and typically as we get towards the end. So last week was what we could generally consider to be a fairly substantial sell-off on a historical basis. Now I'm just going to zoom in slightly on this metric here. We have two here. That was the short term. That was in the monthly view. And essentially over the last month, price performance has been pretty grim. Now what these two metrics are, you may have heard this before, compound annual growth rate. or sometimes summarized to, in this instance, CAGR. Now, what we're looking at here is a 4-year cycle. Bitcoin tends to trade in these 4-year cycles, and whilst we can all argue that they may diminish over time, the impact of that 4-year cycle may start to fade away as the halving gets less of an impact. Typically, we see a 4-year cycle, and even if we didn't have a 4-year cycle, we typically have a bull and a bear within a 4-year period. So we're kind of getting a like-for-like comparison. That's why I've chosen this in this particular instance. Now, the concept of a compound annual growth rate. So over a 4-year period, take the current price and take the price we were 4 years ago. Now, draw a straight line between there. Let's just say it's 10,000 and 40,000 for easy math. How much does Bitcoin need to grow as a percent each year to actually reach that point? That's what the compound annual growth rate is. So if it needs to add $10,000 a year or $5,000 a year as a percentage, it's showing what is the percent growth of the asset in order to achieve that endpoint. So what we're essentially seeing here, and you can see through after the 2017 rally, through much of 2018, 2019, there was oscillations, but note how we tended to trade between somewhere around a bottom of 75%. We got up to around 150%, but if you drew a straight line through here, it would be roughly 100%. So the interpretation there is that Bitcoin was essentially appreciating at a rate of 100% per year during that 2018 through to 2020 period. Now, if we look back here in 2016 or 2015, we can see this was much higher, 250%, 240%, 150% at the lows. So we can see that overall, the compound annual growth rate did diminish over that cycle. We moved into our 100% per year rather than the early days, where it's going from cents to dollars, and we were getting 250% or even higher. You can see that we stabilized here more or less between 75 and 150 with an average about 100%. Now, this held all the way through to our top here in April 2021. This is when Coinbase direct listing went in, and that's before we had our sell-off. That sell-off took us back to the lower end of this range, 87%, 75%, 90%. But note how this next rally and then our current sell-off, this next leg of the bear, has actually descended us down into 32%, 55%, 42% of the current era. So it's actually put a significant dent in the 4-year price performance of Bitcoin. And you can also see that the general trend does happen to be lower. So we're seeing that diminishing return profile. Now remember, that also doesn't mean that we're not currently in a phase which is non-representative and we may well get a bounce back higher. All these things can happen. But what we are seeing is, in a macro scale, we are seeing diminishing returns over time. And this bear in particular has put a nasty dent in our long-term price performance, at least on a 4-year cycle. Perhaps that signals we're moving out of a 4-year cycle and into a more 10-year or an 8-year type cycle along the macro environment. It may also signal that in this new inflationary regime we're in, maybe the rules are completely changing. We actually have to pay attention to how this evolves. Maybe 4 years is now completely irrelevant, or maybe we are in fact seeing a severe diminishing of returns. We will have to wait and see. Now, you can also see that Ethereum is not immune to this. It is in fact ascending at a very, very similar type rate. And during bear markets over the last, really since July last year, these two metrics have more or less traded the exact same. They've been coupled together. And Ethereum has actually underperformed Bitcoin during the bear, whilst it overperforms during the bull. And again, for those who have seen these market cycles before, this may sound very familiar. We typically hear that, as you go further out on the risk curve, you see higher returns in the bull, but they underperform in the bear. And if you actually go and check the newsletter, we actually plot these over each other and you can see that effect. You can visualize what's going on. And the last little takeaway is that these peaks during the bull market where Ethereum outperforms have in fact also been diminishing. More or less, it's outperforming to a lower extent over Bitcoin as it gets larger. And again, if we kind of wrap all this together, we are seeing that general diminishing returns over time. A lot of these things you may have heard in the market, actually we can visualize these things and see that they are in fact genuinely true, at the very least on a 4-year time frame, and in particular on a monthly time frame. It's been a pretty nasty period of time. So kind of putting a little bit of these things into context. Now, just before we move on and start looking at the derivatives in the on-chain space, I just want to touch on the Bitcoin and Ethereum, what I call market cap dominance. So generally what we see is that Ethereum typically is a bit of a bellwether. When we see Ethereum outperforming, it's generally at the start of a bull or in the middle of a bull where we start to see that the rest of the digital asset space starts to catch a bid, money rotates out of Bitcoin, and we start to see people move further out on the risk curve. So generally outperformance of Ethereum, which is where we see Ethereum, we see this dominance chart start to decline. You can see that we saw this during the first part of 2020 and into the 2021 market. Bitcoin dominance was declining, and then we saw a major outperformance where Ethereum starts to dominate. These low values here is comparing Ethereum's market cap performance to Bitcoin, and it's showing that we're having a general, in other words, an alt season at that point in time. Now, what we also saw is here in the 2017 period, as we kind of got to the middle of the bull when things really started to get parabolic, we saw the same. Ethereum started to pick up some serious steam and outperform all the way through to around halfway through the bear market. But note this big divergence. This big divergence over time as the bear market started to set in was a signal that we were moving back into a Bitcoin dominated market structure. Now, we can see that we do have a bit of a divergence that has been developing really since the all-time high, but really December was kind of when that started to kick in. And we can see there is a divergence starting to develop. So we may be starting to see that capital rotating back out away from Ethereum and away from these other altcoins back towards Bitcoin. But also what I want to highlight, note how the Ethereum dominance was much, much stronger. Note here how it was kind of jumpy and it peaked back in. It was the market trying to work out what was going on. Ethereum was much, much less developed back here in 2017, 2018. Whereas what you can see here is that it maintained that dominance for a lot longer. So it's showing that the market has developed a bit of an appreciation for what Ethereum is. It looks like it's here to stay. The market is showing that in the way that we're looking at the actual price performance. So you can start seeing these concepts you may have heard about in the market, whether anecdotally or hearing people talking about it. You can start to actually visualize these concepts by using these price performance metrics. So again, we have to wait and see how these things all play out, but we've got a bit of a signal that we may be heading back towards that risk-off type period. And again, we have to keep in mind here that the dollar at this point in time is outperforming both assets. So whilst we do have that relative performance, they're also within the context of a larger macro cycle. So now we're going to move into the derivative space. And this first chart up here is looking at the 3-month futures basis. Now, the way to think about this, it's a cash and carry trade. So people can buy spot, sell the futures, and lock in a premium. Now, really, there's a big takeaway I want to have from here. The orange line is Bitcoin, and the blue line is Ethereum. Now, remember that this is looking at all futures markets and how much you can essentially yield by doing this cash and carry trade. Now, isn't it interesting how these two are moving in lockstep for the entirety of this bull market? What we can otherwise see here is that anywhere that there's liquidity and yield, traders, algorithms, people using strategies are essentially utilizing the liquidity and trade volume of both Bitcoin and Ethereum. These two are both seeing they're moving in lockstep. The amount of yield that can be obtained from either of these markets is moving in tandem. And it's really showing that we do have this kind of in lockstep. Traders are using both instruments because they have now reached a kind of a level of escape velocity where they have enough liquidity and enough volume to actually execute these trades. But it's very interesting that these have actually converged to be more or less yielding the exact same. And we can see this as well in the implied volatility. This is the options when they're pricing in what the kind of risk profile is in terms of volatility. And you can see that, I mean, these charts on the left-hand side is Bitcoin and the right-hand side is Ethereum. You can more or less plot these one to one, and they look very, very similar. So in general, what we've seen is a compression of this volatility over time. Now, when volatility gets compressed, generally speaking, it precedes some kind of higher volatility move. The market kind of lulls itself into a bit of a sleep, and then you get this major impulse of net volatility. And we saw this during, well, essentially 12 months ago when we had the first May sell-off, and here we are with May sell-off version 2, this time the lunar edition. So you can see that these periods of low volatility preceded these large volatility moves. It almost doubled for some of those shorter term options. So we can see that the market essentially priced in this large impulse of volatility. And what we can generally expect is this kind of going to trigger the next move. We've seen that flush out. The market's going to try and consolidate. Volatility will creep out of the market, and that generally precedes the next volatile move. And it can be in either direction. Now, another thing to note is that this is where we start talking about what is the market sensing in terms of the overall directionality. Is it fearful of downside? How is the options market actually considering the current structure? So again, we have BTC on the left and Ethereum on the right. What I want to highlight is this uptick that we've seen. This is what's called the put-call ratio. So a put option is like downside insurance. It's someone who's buying saying, I actually want to insure my current position below this level. Whereas a call option is the opposite, often used for speculation. People are essentially saying, I think Bitcoin's going to go above this strike price, and I'm going to speculate that it's going to push higher than that. You can also have risk hedging in both directions, but we'll leave those details for now. The important observation here is that we've seen an uptick during the sell-off, and in fact, it's been somewhat elevated over the last 3 to 4 months for both Bitcoin and Ethereum. This means that more people are preferring to open put options. That's downside insurance. People are trying to insure and hedge their positions by buying downside insurance, and during this sell-off, we actually saw an influx of people opening up even more insurance. Now, giving us a bit of a time scale, because this is these options can be purchased at various expiration dates. So when are people buying their insurance? What we see here is that this is the 29th of July, so about 2 months, 2 and a bit months away. Note how significant the put options here in pink are. You can see that there are some calls, but most people are actually buying put options, and their strikes are around 15,000, 20,000, and 25,000. There's another set here at 30,000. But you can see that people are essentially going to those 5,000 round numbers, and there's a concentration of puts. At least 2 months out, the market is a little bit fearful of downside. There's also going to be people who are speculating on further downside buying these put options. But generally speaking, we see that there is an influx of people who are more bearish, trying to hedge their risk, trying to manage their positions, and expecting further downside in the near term. Now, then let's look out to the year's end, 30th of December. Note that this particular option spread looks quite different to the one on the left. We have a lot more speculation going on at 70,000, 80,000, 100,000. These are people who are buying call options that are well and truly out of the money when we're trading very low. Now, just a little bit of quick option math here. When volatility is low, that means that generally speaking, the market's not expecting a very volatile move, and therefore options are typically cheaper, particularly for buyers. So what we may well have seen here is these call options, people have actually taken advantage of this low volatility environment where options generally are quite cheap, and they step in and actually start speculating and expecting more upside further out the year. Now remember, this absolutely does not mean that we're going to head up to 70,000, 80,000 or 100,000, but it shows that the market is betting, at least to some extent, that there is at least some probability of this happening, and they're taking advantage of that low volatility environment to put these trades on. Also note that our put options are far less prevalent. People are more concerned about the immediate 2 to 3 months. They're more concerned about what's going to happen in the near term. We're seeing a lot of that insurance being bought near term, much less of it in the long term. And also note that the strikes here are 25,000 and 30,000 rather than 15, 20, and 25. So they've kind of stepped up their expectations a little bit. So it's a little bit more constructive, but we also have to bear in mind there's going to be some speculation capital in here taking advantage of that low volatility environment. Now, lastly, let's close out on the on-chain space, and I want to really capture this from an on-chain fee perspective. Now, when lots of people are sending transactions, people are flowing into the network, all is good, the media is hyped, everything is exciting, full raging bull market, it typically manifests as an excess of people trying to get blocks by their transactions mined into blocks. They're willing to pay a higher fee to do so, and we see congestion manifest as fees being higher. Ethereum, similar concept, but also has a thriving blockchain ecosystem. There's DEXs, there's money lending protocols, there's all sorts of things that are going to coax in and get people to be using the blockchain. So it's a slightly different model to Bitcoin. We do have to consider them separately. They aren't directly comparable, but that's a story for another time. Nevertheless, what we've seen is that Bitcoin, particularly since last May, so the last 12 months, note how fees have essentially moved into bear market territory. We saw a slight uptick during the lunar sell-off. This is a panic sale. These are people who are essentially going, I need to get out quick, just get me to an exchange, but see how that's already dying off. This is one of those characteristic bear market events where you see transaction fees really start to decline. Now, even with Ethereum's thriving ecosystem and factoring in the lunar sell-off here, see this second spike, and this one here was one of the all-time highs in terms of ETH burned. This was the Bored Ape Yacht Club releasing their next collection. Generally speaking, since the all-time high or just after it, we've also seen a descent in the overall gas price paid. We're seeing that overall fewer people are rushing in. There's less competition for block space. The demand for block space, it's still there, but it's tempered. It's a lot lower than it was. So this is just one of these realities that we have to face in a bear market. We see fewer people coming in. There's less excitement. Fewer people are using the protocols. Fewer people are trading tokens. We see less speculation. All of these things tell a very cohesive story, and we can see it playing out in the data. Now, for Ethereum in particular, there's a knock-on effect when you do have this descent in overall gas paid, is that the EIP 1559 implementation that burns ETH, when you have a lot of activity, and you can see here the Bored Ape Yacht Club, it burnt a all-time high of over 38,000 ETH in one day. Pretty remarkable stuff. But you can also see that over time, this has been declining. It's only been active since August last year, but it has been declining. And actually where we currently are, we're down at 16 points. In fact, it's even lower than that today. It's 14.5% of the overall minted ETH is actually being burned, which means that the other side of that, the 86% is actually moving into circulation, or the 86% is moving into circulation. So there is actually an impact in terms of supply dynamics because we have an all-time low of ETH being burnt right now because we have low demand for lower demand for block space. It's still there, but it's lower than what it was. We have an all-time low in terms of the burn, which means we actually have more coins being issued. Now, again, that doesn't necessarily mean the end of the world. That's just part of these dynamics we have to be aware of, but it kind of shows how demand, when you have a burn system, can actually impact the amount of supply coming into the market. So there's kind of this to and fro, and generally speaking, if you get too much supply, you can get negative impacts on price, and that can kind of further exacerbate the overall demand profile. It's one of these very interesting problems that we really have to study from multiple angles. And just to close out, we're looking at, so that was kind of Bitcoin and Ethereum. Let's now look at DeFi tokens as a good example. Now I've got only a handful of metrics here. Active addresses for Aave, Compound, Uniswap, and YFI, just trying to capture a nice section of the market, DEXs, money managers, things like that, lending protocols. This is active addresses on the top. And we have a very, very similar pattern for total USD transfer volume. So the amount of value of comp, for example, that's being transferred over the Ethereum network. Now, what I really want to just highlight here is note how the active address chart for all of these looks quite similar to the price chart. It's really showing that it's not a one-to-one, and it's not a perfect metric, but it's a simple model to just look at, are we seeing more people transacting the tokens, more people trading them on DEXs, more people sending value to exchanges? Are we seeing more value flowing in or less? And what we can see is that there's a bit of a correlation here between the overall activity or the interest on chain and the token's price appreciation, which at this point in time generally is not great. So much like Bitcoin and Ethereum, they are also taking hits, which is manifesting as lower gas fees, you can see how all of these things is a very, very big and cohesive story. And really, if I want to leave you with one thing, that's probably the takeaway from a lot of these sessions. I do hope that as you watch these week on chains, you identify that we can use multiple tools to essentially tell a very, very structured, cohesive story. Generally speaking, if we look across all these markets with the right tools, we can see a consistent story, and that helps us understand what is happening, what could happen in the future, and therefore what we can pay attention to in case one of these things start to change. So you can see here we had a bit of an uptick on some of these tokens, hasn't yet been reflected in prices. We have to see whether that was just people panicking and capitulation last week, or is there potentially a bit of a trend starting to reverse? But these things that work to the downside, it's likely that when we do finally put some kind of a bottom in, we can use these simple tools to start tracking our way as we navigate out the other side. So thanks for tuning in for that one, folks. Hopefully you learned something new about price performance metrics, compound annual growth rates, Bitcoin, Ethereum dominance, how you can see these narratives play out in the data. So I do hope that this has been useful. The bear is still in effect. We do still have lackluster block space demand. We have some way to get out of this rocky road. We will get there, but the reality is that these things generally take time. And what we're trying to establish here is some of these metrics we can use to track our progress through the bear and start looking for when those signals of recovery start to come out the other side. So thanks as always for tuning in, and I will see you next week. Cheers.